Hello, Tim Kerin here from Mortgage Choice in Kingsley. It's the middle of April 2022, just a bit over 2 years since COVID hit, and there's a lot going on with interest rates, and I'm getting asked questions on a daily basis about are they going to go up, how much are they going to go up by, and how's it going to affect me. So I thought I'd just talk a bit about what I know and try and explain some helpful concepts that I've noticed and that I understand just as a result of dealing with lenders on a daily basis. But I don't presume to have a crystal ball, and in fact, often the question I get asked is, I know you don't have a crystal ball and you're not allowed to give financial advice, but what should I do and what's going to happen? And clearly I can't answer that. Here's what I can say. I can see that we're in an environment where rates were at the lowest they had been in the history of Australia. When I say rates, I mean the official cash rate of the Reserve Bank prior to COVID. And so fixed rates and variable rates had been falling for a very long time, and they were both at around 3% or so before COVID. Then when COVID hit, a whole bunch of monetary policy came in from the Reserve Bank and the government, and fixed rates suddenly dropped down to around 2% or even a little bit less. And so a lot of people decided to fix. Over the next 12 to 18 months or so, variable rates trickled down to around that mark, which is where they still are. So at the moment, some people can get a fixed rate below 2%, and plenty of people can get a fixed rate a variable rate below 2%, and plenty of people can get a variable rate in the range of 2 to 2.5% or so. Depends more than it ever used to on your LVR and the amount you're borrowing. So if you're getting a 95% loan, your variable rate might be closer to 3, but if you're under 80% and it's a decent sized loan amount, then you might be closer to 2%. Fixed rates were quite low, as I said, in the low 2s, but in the last few months they've shot up to the point where right now, at the time of recording, a good deal on a fixed rate loan might be 2 years at about 3.4% or something like that, and most 2 and 3 year fixed rates are up around the 4% mark. So rates have really shot up. So if you're thinking to yourself, I want to fix so I can do something about the rate rise that I'm hearing about, it's too late. Fixed rates have already gone up. And so what I'm seeing a lot of people decide to do at the moment is stay on variable, get the best variable rate they can, and ride the wave. So it depends on your situation, but a common situation I see is that someone can get a variable rate starting with a 2, and the fixed rate that they might be able to get, it might be 3.5%. There might be a 1.5% difference between what variable rate they can get right now and what fixed rate they can get right now. Or it might be a 2% difference. It depends on the situation. And so if you're thinking, I'm worried about rates going up by 1%, should I fix? I would say the answer is no, because if you get a good variable rate and it goes up by 1%, that's still going to be cheaper than the fixed rate you can get right now. So if you think rates are going to go up by 1%, over the next, say, 3 years, then I would say a variable rate looks like a better deal than a fixed rate for that reason. But of course, we could be wrong. And if you think rates are going to go up by 1%, you could be wrong. It could go up by 3%. And that's the conundrum. Maybe these fixed rates are a good deal because we don't know how much rates are going to go up by. And I don't know either. Likewise, if you think rates are going to go up by 2% and you're on a variable rate of 2.5 at the moment, so you're concerned that rates might go up to 4.5, for example, can we get a fixed rate cheaper than that? Probably. But the third thing to factor into the mix is that if the variable rate goes up, if history is any guide, it's not like we're expecting the variable rate to jump by 2% all at once. That's never happened in the history of the Reserve Bank, which dates back to the 1960s. That's never happened. Rates have dropped dramatically when the when the Reserve Bank has needed to drop rates to help with things, as happened when the GFC hit. If I recall correctly, it was 1.75% across 2 months was the drop that suddenly happened when Lehman Brothers collapsed in the US. And when COVID hit, the Reserve Bank dropped the cash rate pretty quickly. But certainly in my 19 years, I've only ever seen rate rises of 0.25% at a time. And nobody's seen the Reserve Bank put the official cash rate up since 2011. That could be wrong. It's a roughly then. So in fact, it might have been 2009. It would have been 2009. So yeah, we're looking at about 13 years since the Reserve Bank put the official cash rate up. There is so much hype in the media about rates going up. People have been asking me, concerned, reading an article in some kind of media about how people might be affected by rates going up. ever since COVID happened. And ever since COVID happened, there's been all this talk about rates going up, but it has not happened. And so I'd say the first thing to think about, if you see an article that alarms you, recognize that that article has been designed to alarm you. The typical thing I see that frustrates me no end is an article that says that where the title is something like, "Will homeowners be affected by a rate rise?" Or will homeowners be affected by Reserve Bank putting rates up? Or will homeowners, something more dramatic than that. It's asking a question that sounds scary, but then if you actually read the article, the answer to the question is no. The actual journalist is explaining why nobody needs to be worried about that question. But if you don't read the article, you think that you should be concerned about it. What I would say is stuff like that is horrible and should be avoided. It's misleading. What is much more helpful is to look at facts. You can go to the Reserve Bank website and look up the announcement they make on the first Tuesday of every month when they meet and decide to do what they want to do with the official cash rate. What the actual governor of the Reserve Bank and the board and the business people they have involved on the board to make those decisions think every single month, what they actually think and what they're planning for and what they're expecting and why they're making the decisions they're making. That's much more helpful than scaremongering. So I'd say stay away from the scaremongering, please, because it doesn't help. And I'm not saying you shouldn't be concerned about rates going up, but please look at facts. And then just think about what sort of a difference rates are actually going to make if rates change the way you're thinking. Try and get an idea of what you're thinking they might do. And the final piece of that puzzle is to look at fixed rates. Fixed rates tend to be a projection, as far as I can tell, of what lenders are expecting to happen over a particular period of time. So if a bank is offering 4.5% as a fixed rate over 3 years, then that tells me that they're expecting to need to charge 4.5% over 3 years to still make the profit they want to make. In other words, they're expecting rates to go up, because the counterbalance to that is they also want their fixed rate to be competitive enough that they actually get business. They could also put their rate up to 15% and make plenty of profit, but no one would take that deal. So there's a balancing act there between how high can I go to make sure I make a profit and how low does it still need to be so that I actually win business. And they compete with each other like that, but they're still factoring in the price rise. They don't want to compete in a market where they're not going to make any money. So fixed rates tend to be a projection of what people with lots of money think rates are going to do, and that can be a bit of a guide. They're not always right. They didn't predict the GFC, and they didn't predict COVID, but they're often right. And if they're any guide right now, then it looks like they're expecting rates to go up by 1 to 1.5%, maybe 2% over the next few years. It doesn't look like anyone thinks rates are going to go higher than that over the medium term, and that's worth thinking about too. And so that's probably why a lot of people that I've been speaking to lately, particularly people that have experience with home loans that might be borrowing money for the 10th time, are saying, no, I'm not fixing, I'm going variable because it's a much better deal than fixed at the moment, and I'll just ride the wave. An important part of that decision is how much you can actually absorb as a rate change. And that's a pretty easy thing to figure out. Multiply how much you owe by what rate change you're concerned about, and that'll tell you how much per year more it's going to cost you. If you have a $500,000 loan and you're worried about it going up by 1%, that's a $5,000 per year change. But if you fixed at 2% higher to do something about it, you're locking in $10,000 a year more just to prevent the rate rise. So it's worth thinking through rates and thinking through and quantifying what's going on. What I can see at the moment is that fixed rates have already shot up. Variable rates look very attractive to me based on what I think in my crystal ball that nobody has is going to happen. I can't see any reason for rates to jump more than 1.5% to 2% over the next few years, but of course I could be wrong. I hope that helps you think it through. And if you'd like to talk any more about that, or this has triggered some more questions for you, feel free to get in touch. That's what I'm here for. Cheers.